Hey there, and welcome. Have you ever looked at those massive, shiny office buildings or giant warehouses and thought, man, I wish I could invest in that? But then you think about the price tag and, yeah, it feels impossible. Well, what if I told you that you can get a piece of that action, and you don't need $1 million to do it? Today, we're going to break down the exact investment tool that makes this whole thing possible. All right, let me just throw this out there. What if you could buy a piece of real estate for, I don't know, 500 rupees? I'm serious. No crazy down payments, no dealing with brokers, just you owning a tiny slice of a big property. It sounds a little too good to be true, doesn't it? Well, believe it or not, the answer is yes. It's totally possible. And the secret sauce here is something called a REIT. That's REIT. And that's exactly what we're going to unpack today. Okay, so first up, what on earth is a REIT? Honestly, the easiest way to wrap your head around it is to think of it like a mutual fund, but instead of stocks, it's for real estate. So a REIT stands for Real Estate Investment Trust. It's basically a company that collects money from a whole bunch of investors, people just like you and me, and with that big pool of cash, it goes out and buys and manages properties that make money. We're talking about things like huge office buildings, shopping malls, maybe even those massive data centers. And how it works is actually pretty straightforward. You put in your money by buying units of the REIT, kind of like buying shares of a company. The REIT takes all that money and buys up some great properties. Then it rents those properties out to tenants and, of course, collects the rent. Now here's the magic part for you. A big slice of that rent money comes right back to you as regular payments called dividends. It's a really clean and simple cycle. Okay, that leads us to the big question, right? How do you actually make money from this? Well, there are two main ways you earn returns from a REIT. The first one is that regular income we just mentioned, the dividends. That's your cut of all the rent being collected. But there's a second way, and that's capital growth. See, just like any piece of real estate, the value of the buildings the REIT owns can go up over time. And when the value of the whole property portfolio increases, the value of your units goes up too. So you've got income and growth. It's a pretty powerful combo. Now, you might be thinking, okay, but how can I be sure I'll actually get paid these dividends? Well, you can be sure because it's literally the law. Here in India, the regulator SEBI has a rule that says REITs have to pay out at least 90% of their cash flow to investors like you. So it's not a maybe, it's a must-do. And there's another safety net built in. SEBI also says that at least 80% of the REIT's money has to be in properties that are already built and are already collecting rent. Why is this so important? Because it means there's a steady, predictable flow of cash coming in. It reduces the risk of them putting all your money into a building that's still just a construction site with no tenants. But for me, this next part is the real game changer. Think about selling a house or a flat. It can take months, right? It's a huge hassle. Well, REITs are traded on the stock market, just like shares of a company. That means you can buy or sell your units pretty much instantly, anytime the market's open. That easy access, that liquidity is a huge, huge plus. Okay, so this is all sounding pretty good, I know, but, and this is important, this isn't something you just jump into blindly. You wouldn't buy a random stock without doing a little homework, and it's the exact same idea here. So let's go through a simple 5-point checklist that you can use to analyze any REIT out there. This is the mindset you gotta have. Don't just buy a REIT, analyze it. Think of it as an active investment, not just something you set and forget. A little bit of homework up front can make all the difference in picking the right one. All right, so here are the 5 big things you absolutely need to check out. Number 1, what kind of properties do they have and where are they located? Number 2, what's their occupancy rate? Number 3, who are the tenants renting from them? 4, how much debt does the REIT have? And finally, number 5, what's its net asset value, or NAV for short? Let's dig into each of these real quick. You've heard it a million times. Location, location, location. And it's just as true for REITs. You want to see properties in high-growth areas. So, for example, if you see a REIT that's heavily invested in places like Bengaluru and Hyderabad, you might think, that's where the big tech, AI, and data center boom is happening. You've got to connect those dots. Next up, you have to look at their tenants. First, you want a high occupancy rate, like over 90% is great. That means the rent money is flowing in steadily. But it's not just about that. You also need to check who the tenants are. Imagine a REIT that gets almost all its rent from just one industry. If that industry hits a rough patch, the REIT is in big trouble. A much safer bet is a REIT with a good mix of tenants from different sectors. Some tech, some finance, you get the idea.
All right, now for what is maybe the most important number to look at, NAV, or net asset value. Just think of it like this. If the REIT sold off all its properties and paid off all its debts, the NAV is what would be left over per unit. It's the true underlying value. And what you do is you compare that true value to the market price, the price you actually pay on the stock market.
And this is where it gets really interesting. This comparison tells you if you're about to pay a premium, meaning more than the properties are actually worth, or if you found a discount where you're buying it for less than its true value. And, finding those REITs trading at a discount to their NAV, well, that's kind of the holy grail here. But of course, like any investment, it's not all sunshine and rainbows. There are risks involved. So, for this last part, let's take a good, balanced look at the pros and the cons. So on the plus side, the benefits are pretty clear, right? You can get started with a small amount of money, you can buy and sell easily, and you have pros managing the properties for you. But on the flip side, the risks are real. If the whole real estate market takes a hit, your REIT will feel it. They can also be affected by changes in interest rates, and because they trade like stocks, they can go up and down with the rest of the market. So there you have it. We've gone over what REITs are, how you make money from them, the checklist to analyze them, and the pros and cons. You've got the basic toolkit now to really dig in and make a smart decision. So the only question left for you is, now that you know all this, will REITs find a place in your portfolio?